I'm Professor Indra Abeysekera. Let's look at how we eliminate intra-group inventory that has been transacted during this period and entirely held at the end of the reporting period. When inventory is transacted at a gate within the group, one entity, the entity that sells the inventory, makes a gain which is unrealized, and the entity that receives the inventory records that inventory at a higher value than it should be for the group. So we need to eliminate the overvalued inventory and the unrealized gain. When we eliminate the overvalued inventory and unrealized gain within the group, there's a taxation impact that changes the income tax expense and creates a deferred tax asset. For us to understand the consolidation entries that follow, we will make a couple of assumptions here that the parent and the subsidiary entities are tax-paying entities and the group is not paying taxes. Second, the periodic inventory system is used within the group by individual entities. So as I alluded, we need to eliminate the overvaluation and the unrealized gain, and there is a taxation impact as a result of eliminating the overvaluation and unrealized gain. Let's try to understand the consolidation entries that follows through an example. On 1st of July 2018, parent acquired 80% of shares of the subsidiary. And on 1st of January 2020, subsidiary sold inventory of 24 million for cash with a markup to the parent entity. And 30th of June 2020, the entire inventory is still on hand with the parent entity. And the income tax rate is 30%. And we will prepare consolidation journal entries at 30th of June 2020. What we need to realize here is that the acquisition took place 2 years ago and parent acquired 80% of shares or the ownership of the subsidiary. But when it comes to intergroup transactions of buy and sell nature, we eliminate the unrealized gain and overvaluation in full 100% regardless of the ownership percentage. For us to understand about the unrealized gain and overvaluation, we can look at the subsidiary which sold the inventory at 24 million, where the cost was 21 million, making a a gain which is unrealized of 3 million. This 24 million of sale became purchases under cost of sales in the parent entity and at the year end, because it was unsold, became inventory and was transferred to the balance sheet. That 24 million comprised 3 million of unrealized of overvaluation, which represents the unrealized gain made by the subsidiary. The inventory, the cost value to the group is 21 million, regardless of the location, whether it is in the subsidiary or the parent entity, because a group is the combined entity of the parent and the subsidiary. If we look at the individual entities' general journal entries, the subsidiary took the inventory out of the warehouse and prepared as cost of goods sold, which is 21 million, and then sold it for 24 million and received cash. The parent entity paid cash of 24 million and acquired them as purchases, which is part of cost of goods sold, 24 million. At the end, that cost of goods sold was taken out of that account and became inventory, 24 million. If we combine the two sets of general journal entries, we can see on the two first journal entries in the first two arrows with figures, cash and cash get cancelled, debit and credit. We end up with credit sales 24 million and debit cost of goods sold 24 million. When it comes to the unrealized gain and overvaluation of inventory, the last two rows of the general journal entries, we can combine them and we come up with inventory, a net value of debit of 3 million and cost of goods sold of 3 million. Which is a credit. So it is this general journal entry that we have to eliminate. We eliminate these general journal entries, the summarized general journal entries, as consolidation journal entries when preparing consolidated financial statements for the group accounts. So our first journal entry, consolidation journal entries, is to debit sales and credit cost of goods sold of 24 million. The second consolidation journal entries is to credit inventory 3 million and debit cost of goods sold 3 million. We debit cost of goods sold 3 million for the unrealized gain on the sale of inventory. Because it's a trading asset, inventory, there is no dedicated account such as gain on sale of non-current assets for us to separately or distinctly debit the gain. Instead, we debit to the cost of goods sold as we have understood through the general journal entries. When we make the second consolidation journal entries, because we increase the cost of goods sold, profit decrease in the group, therefore the income tax expense decrease in the group. 30% of 3 is 0.9, we credit income tax expense. Because we decrease the inventory, or the carrying value of the inventory is decreased, so for the group, there's less cash inflows arising in the future from inventory, and there would be a future tax saving, and 30% of 3 is 0.9. So we debit deferred tax asset 0.9 and credit income tax expenses 0.9. So when it comes to inventory intergroup transactions, there are 3 sets of consolidation journal entries. First one is for buy and sell transaction. Second one is for unrealized profit and overvalued inventory adjustment. Third one is for deferred taxes arising from adjusting for unrealized profit and overvalued inventory.